guys, welcome to CADS 3853 module number 15. In this module we're going to continue our inventory discussion, especially we're going to talk about stock efficiency or inventory efficiency. Okay, stock and inventory are the same thing. They mean exactly the same thing. So I may interchangeably use these two terms. I may say stock efficiency, inventory efficiency, they mean the same thing. Okay, there are a few different stock efficiency measures that we have to understand. And in this module, I'm going to particularly focus on the turnover or stock turnover or inventory turnover as one of the stock efficiency measures. But before we talk about stock efficiency, let's talk about efficiency in general. What do we mean by being efficient? Okay. When we say efficient, that is not the same as effective, right? Efficient has some concept comparison between the input and output. The input that we put in versus the output that we get out, right? So being efficient basically means we put the minimum input to get the maximum output, right? So accomplish the maximum outcome with the minimum effort. That's what it is. When we say, well, I was efficient in preparing for an exam, that means I spent really only necessary amount of time to achieve really high score, right? If I had to spend many days and achieve the same score, that would be less efficient than another student who spent just 10 hours on one day and got the same score, right? So being efficient basically means you are using your resources in a very economical way and a satisfactory way, so that you're using the resources in the least wasteful manner. Okay? When we talk about efficiency in terms of the merchandise assortment or merchandise management or inventory management, then what would that actually mean? When we think about the inventory efficiency as an extension of the general discussion of what's being efficient, then again we have to think about the input and output, right? The goal of a business is to make profit. So profit is our best measure of our output, right? But profit comes from our gross margin or our net sales, right? Sales and gross margin lead to our profit. So we want to generate as much those good output, such as sales, net sales, or gross margin, or profit, and those things, given the least wasteful investment, right? So in this case, investment means investment in our merchandise assortment. So inventory efficiency basically means that you plan and control your merchandise assortment, your inventory, so that the inventory does not sit in the store long time, not moving through the store, but that the merchandise actually sells rapidly, so that they are moving through the store quickly, and so that they will generate profits and the money that for new merchandise and things like that. So you can imagine that it is absolutely important for us to keep track of the inventory efficiency, how efficient we are with our current inventory. And also when we plan our inventory investment or the inventory level or stock level, we plan first the efficiency measures. Right? How efficient do we want to be? That's the first thing that we plan. And based on that plan, we are going to now be able to calculate how much inventory that we need to have for us to be able to meet these efficiency goals. Okay, so like I said, we need to first have the efficiency planned, right? Then we need to know what kind of inventory efficiency measures can be used for inventory planning. Okay, so there are multiple kinds of efficiency measures like turnover and GMROI or SSR. We're going to talk about all about this, but in this module we're going to particularly focus on the turnover as one of the inventory efficiency measures. Turnover is probably one of the most frequently used inventory efficiency measure, a measure that assesses how quickly the inventory moves through the store. Turnover can be interpreted in a couple of different ways. The first way to interpret turnover is understand turnover is the turnover as the number of times the average retail stock, the amount of stock is sold and replaced during a given period. So if we say a seasonal turnover of 3, that means during the season, the entire stock was sold and replaced 3 times. Another way of understanding turnover is to interpret it as the amount of sales dollars that is generated by $1 invested in the average retail stock. Okay, this interpretation directly comes from the formula that we use to calculate turnover, which is given at the bottom of the slide. Turnover equals net sales divided by average retail stock, average stock at the retail value. Okay, the net sales, during a certain given period of time, like say seasonal turnover, you mean 6 months. Okay, a season means 6 months in the merchandising calendar. Okay, so for the 6-month season, okay, how much sales were produced? Okay, and you divide that by average stock level. Okay, what was the average stock during the 6 months? Okay, that average stock retail value, average retail stock level. So you divide the net sales by average stock level. That tells you the amount of sales dollar that were generated in every dollar that was in average retail stock. Okay, if you just directly interpret the meaning of the formula, that will be the interpretation of turnover, right? But if you think about it, that is again saying the same thing, right? As saying, well, that's the number of times that average retail stock, that much of amount of stock was sold, right, and replaced during the season, right, during that period. Okay, turnover can be calculated for different season, different periods. Like it could be a seasonal turnover, it could be annual turnover, it could be quarterly turnover, monthly turnover, etc. We'll talk about the period that is used for turnover calculation later on again. So knowing the turnover calculation formula as well as the meaning of the turnover figure, how to interpret turnover figure, let's work on this one problem. Okay, let's say gross sales annually for this company or store was $497,500. That's gross sales. And then this company had a customer returns of 47,500. So there's a customer returns, and we instantly, when you see gross sales and customer returns together, you know that you can calculate net sales, right? And then average inventory at the retail value. Okay, like I said before, inventory, stock, they're meaning the same thing, right? This average inventory at retail is the same thing as average stock at retail, or average retail stock, average retail inventory. They all mean the same thing. So on average, the inventory level, okay, was $105,572. Okay, if that was the case, let's first calculate net sales given the gross sales and customer returns figure. And then let's calculate inventory turnover. Okay, let's pause the video. Okay, so net sales, gross sales minus customer return. So we got the net sales of $450,000 given the gross sales and customer return figures. And then the inventory turnover is net sales over average inventory at retail value. So the net sales of $450,000 divided by average inventory of $105,572, which was given in the problem. So that gave us the turnover of 4.26. Okay. Turnover calculation is not hard at all, right? So what's really important about turnover is whether we know what the meaning of this number actually is. Okay, so how to interpret this number. Okay, you remember a couple of definitions or the ways to interpret turnover figures on maybe a couple of slides ago that we talked about those two different ways. One was the number of times the average retail stock was sold and replaced during a given period of time. Okay, the other way to interpret turnover figure was the amount of dollars generated in the net sales given $1 for every dollar that was invested in the average retail stock. Okay, those two meanings. Okay, given those two meanings, let's try to interpret this turnover of 4.26 that we calculated for this problem. Okay, first, that turnover of 4.26 would mean that the store sold and replaced the average stock, average retail stock, or the entire, that much is kind of an entire stock, and on average 4.26 times annually, right? Because the problem gave us annual sales figure, annual gross sales, right? So the turnover we calculated was an annual turnover. So 4.26 means that the store sold and replaced the average stock 4.26 times during the entire year. Okay? 4.26 of annual turnover and 4.26 of seasonal turnover will mean completely different things, right? 4.26 times, the merchandise moving through annually on the entire year versus 4.26 times just in a season, they mean very different. So when we interpret inventory turnover number, we have to pay very close attention to the period for which the turnover was calculated. Okay? In this case, the period was annual, the entire year, right? Because the sales figure that we used to calculate turnover was the annual sales. Okay, that's where you get the idea about the period. What's the next interpretation? Because we can interpret turnover figure in two different ways. Can you think about it? Yeah, the second way to interpret turnover figure is thinking about it as the number of dollar sales that were generated, right? So that basically means for every dollar that the store invested in average stock at retail, $4.26 were generated in the net sales, right? Again, during the entire year, annually. Okay? So $4.26 net sales were generated for every dollar invested in the average stock at retail, okay, in the year, annually. Both meanings are very important. Okay, the interpretation of turnover and other stock efficiency measures that we're going to learn in next couple of modules are very, very, very important. The calculation is pretty easy, but if you don't know what those numbers actually mean, then you won't be able to utilize them to actually plan the stock level and plan the merchandise and plan and control the merchandise, which is the entire purpose of this class. So the meaning is absolutely important for you to remember. So for calculating turnovers, we had to know what the average inventory was, right? Average inventory or average stock at the retail value. So then we wonder what average inventory or average stock actually means, and how to calculate it. Okay. Before we talk about how to calculate average inventory, we need to learn a couple of stock terms, and they include BOM and EOM. The BOM means the level of stock or inventory on hand at the beginning of the month. So for each month, you're going to be able to have a BOM, like the beginning of month stock, right? And EOM is the end of month, so stock level at the end of the month, okay? So for every month, you're going to have a BOM and an EOM figure. A very intuitive but very important fact about this BOM and EOM is that the BOM stock of one month is the same as the EOM stock of the previous month, right? So for example, April BOM, so that is the stock on hand on April 1st, will be the same as the March EOM, which is the stock level at the end of March 31st. So the amount of stock you have when you close the store on March 31st will be the same amount of stock that you start with in the morning of April 1st. Right? It's very intuitive, very easy concept, but it's very important, especially when it comes to the calculation of average inventory. So here is an example of 6-month BOMs are given, right? So for between January and June, we know the BOMs here, and also EOM for the first 5 months, okay, January through May. And if you see, then the EOM of January is the same as the BOM of February. The EOM of February is the same as the March BOM, and etc. So when we try to calculate how much average inventory we have, the first thing we do is sum all the BOMs in the period and the last month EOM. We don't add all the EOMs for every month because the EOM of a month is the same as the BOM of the following month. So when we add in the BOM of the following months, that basically take into account the EOM of the previous month, right? So for EOM, we only take a look at the last month EOM, okay? So sum all every month BOM, the beginning of month stock level, and then you add in the last month EOM, okay? And then you count the number of BOMs that you added in and the EOM, and EOM is always just one EOM because we only use the last month EOM, right? And then take an average of them. So sum of all the BOMs and the last month EOM together and divide that by the number of BOMs that you used plus number of EOM, which is 1, okay? Then you know what the average inventory level was in your store. Okay, so let's take a look at one example problem here, okay? So the problem setup gives us the BOM of January, February, March, and April, so 4-month BOM, and the EOM of the first 3 months, January through March, as well as the net sales of the first 3 months. And the question asks us to calculate the average inventory at retail for the period between January and March. Right? So what we will have to do is sum the BOMs of January through March and the EOM of March, the last month, March, okay, EOM, and then you divide that by 3 BOMs and 1 EOM were added in, so that will be 4, right? So divide the sum by 4, okay? Let's work on it. Pause the video. So let's take a look at the answer. Well, as I said before, we add the 3-month BOM, January, February, and March. And then the last month EOM, March EOM, 7,400. And then divide that by 4 because we used 3 BOMs and 1 EOM, so that is our 4, right? That gives us the average inventory of 6,766.75. Well, in this example setup, fortunately we were given all the BOMs and EOMs for every month, right? However, what if we didn't have the EOM column here, okay? Even if we didn't have the EOM column here and we were just given the BOM alone, we should still be able to calculate the average inventory for the January through March because we know the April BOM. And April BOM is the same as the EOM of March. Okay, knowing that concept, as long as we know the BOM of April, we should be able to still calculate the average inventory, right? By adding up those 4-month BOM and divide that by 4, because April BOM is the same as the EOM of March, which is what we were supposed to use. So now let's extend the example that we just saw to calculate turnover. Now that we know how to calculate average inventory and we've got the average inventory already calculated, now let's calculate turnover for the period between January and March, those 3 months. Okay. For turnover calculation, remember the turnover formula, which was net sales over average inventory at retail. Let's utilize that. Let's pause the video. Okay, so to calculate turnover, we first had to know what the net sales for the 3-month period was. So we add up the net sales of the 3 months, January, February, March, and that added up to 10,500. Then now we can calculate turnover by dividing that net sales, 10,500, by the average inventory at retail, which we calculated before, 6,766.75, which gave us the turnover of 1.55. Okay. I said before that calculating turnover is pretty easy, but how to interpret the meaning of the turnover is even more important, right? So now that we have calculated the turnover of 1.55 for the given setup, the example problem, okay, then what does that actually mean? Okay, going back to the 2 ways of interpretation that we can have about turnover, or 2 different kind of conceptual definitions of turnover. Okay, can you kind of think about how to interpret this number in your mind? I hope you were able to figure out how to interpret this turnover number by yourself. Okay, so there were 2 different ways we could interpret the turnover, right? One way was that the turnover of 1.55 means the entire stock, or the average retail stock, average inventory, that much of stock was sold and replaced 1.55 times. In this case, between January and March, right? The period is absolutely important when you interpret the meaning of the turnover. So it's a quarterly turnover. 3 months is a quarter, right? So for the quarter or 3 months, 1.55 times the entire stock of merchandise, or what we consider as average stock or average inventory, that much was sold and replaced. Okay. The other interpretation of this turnover figure is that for every dollar that we invest in, that the store invests in the average stock at retail, $1.55 in net sales, okay, were generated. Again, between the month of January and March, okay, for that quarter. As I said earlier, turnover can be calculated for different periods of time. Usually turnover is calculated for the entire year, so it's usually annual turnover. But a lot of times we also use seasonal turnover. See, a season means 6 months. In lay people's terms, a season means 3 months, but for a merchandising calendar, a retailer calendar, a season means 6 months. Okay. We can calculate turnover for the quarter, the month, the week, weekly turnover, daily turnover, all those kind of things. That also means that if we can assume that our sales are pretty consistent across different weeks, different months, different quarter, and different season across the year, then we can also estimate a turnover for a different length of period based on the turnover that we calculate for another length of period. For example, if a monthly turnover was 1.4, that means the stock was sold and replaced 1.4 times in a month, right? Then we can estimate the annual turnover by multiplying that monthly turnover by 12 months, because our year has 12 months, right? Then that means the annual turnover will be 16.8. Okay? And a weekly turnover was 0.2, that means the annual turnover will be 10.4, because a year has 52 weeks, which is again something that you need to remember. A year has 52 weeks. So if weekly turnover was 0.2, then you time that by 52 weeks to calculate the annual turnover. Okay? If you want to calculate seasonal turnover, then you time the weekly turnover by 26 weeks, which will give you 5.2 as your seasonal turnover. Something like that. So you can always convert the turnover across different periods of time, as long as you can assume that the sales are going to be pretty consistent. It may not be exactly the same, but pretty consistent across the year. So going back to the previous example problem that we saw, since the turnover was 1.55 for the 3 months, right? So if we turn that into an annual turnover figure, that would be 1.55 times 4, right? A year has 4 quarters, right? So the annual turnover of 6.2 would be equivalent to a quarterly turnover of 1.55, right? So we can interpret the turnover of 1.55 in that question as like the average stock is sold and replaced 1.55 times quarterly, or 6.2 times annually. Okay, the same way, the next interpretation, like for every dollar that the store invested in average inventory at retail, 1.55 net sales were generated quarterly, or $6.2 sales were generated annually. Okay, we can interpret it in either way. Okay, so why don't we work on another practice problem here? Okay. So what's the department's stock turnover for the period between January 1st and May 31st? So we're talking about a 5-month period, okay, given the following data. And the data include the BOM figure for January through May, as well as the BOM of June. Remember, the BOM of June is the same as the EOM of May. We need the EOM of May to calculate the average inventory, right? And also the data included the sales figure for the first 5 months. Okay, remember the turnover formula is net sales over average inventory. So we'll have to calculate the average inventory and net sales for the period January through May, and then plug those numbers in to come up with our turnover figure. Okay, let's work on the problem, calculate the turnover, and also let's try to interpret the meaning of the turnover that you calculated on your own. Okay, let's pause the video here. Okay, let's work on the problem together now. Okay, we first wanted to calculate the average inventory, and we add up all the BOMs of the 5 months in the period, plus EOM of May, which is the same as the BOM of June, so we end up adding up all 6-month BOMs, and you divide that by 6, and that gave us the average inventory of $36,096.67. Then we added up the 5-month net sales altogether, which gave us the total net sales of $83,000 for the 5 months. Then finally compute the turnover, which is net sales over average inventory. So 83,000 over 36,096.67. That gave us the turnover of 2.3. Okay. So what does this turnover of 2.30 mean? Okay, so that means we sold and replaced the entire stock of merchandise, which is what we considered as much as the average stock, retail stock, 2.3 times in that 5-month period, within the 5-month period, right? And the other interpretation is that for every dollar invested in average inventory at retail, we have generated $2.30 in net sales, again, within the 5 months. Knowing that turnover is calculated based on the net sales and divide that by average inventory at retail, okay, when we want to improve our turnover, we need to work on either net sales or average inventory, or both, right? So when we say improving turnover, what do we usually mean? Do we want to increase the turnover or decrease the turnover? Okay. Knowing the meaning of turnover, which is the speed with which the merchandise is moving through the store, right, sold and replaced, we want that speed to be probably fast, right, fast enough, right? And also we know that the meaning of turnover is the number of dollars generated in net sales, right, for every dollar we invest in average retail stock. So we would like to generate obviously more net sales than less, right? So in usual cases, when we say we want to improve our turnover, that means we want to increase our turnover, right? For us to be able to increase our turnover, what should we do, okay, for the net sales and average inventory at retail? Yes, that's right. We would like to increase net sales for a certain average inventory, relative to average inventory. We want to increase net sales so that we would increase turnover. Or we want to decrease average inventory relative to net sales, right? If we have, for the same net sale, we want to spend less on the average inventory, right? So if we increase net sales and lower average inventory, that gives us some more efficiency, right? Because as we started this module, we talked about what's being efficient. And efficient means less input put for the best output, right? So the net sales being the output, we want to increase the output of net sales while we are minimizing our input, right? The effort, which is the average inventory investment, right? So lowering average inventory and increasing net sales will be the way to improve turnover. Of course, in usual cases, improving turnover means increasing turnover. But does that mean we want to increase turnover to an unlimited level? Just constantly increase? That's not the case. Turnover can be too high, which means you don't want it to be any higher than maybe what you think is considered as an adequate or appropriate kind of turnover in your store. Because a too high turnover actually can mean that you don't have enough stock level, okay, to support your sale. Okay, the turnover may not be high because you're selling really, really well, but because you don't have enough stock, right? Enough inventory. Or that means probably because you bought too little, or you bought quantities that are too small at a time, or you just didn't buy frequent enough, things like that. So that could actually indicate some buying problem unless you aim the turnover to be that high. Okay. Then the next question we ask ourselves would be, well, what would be an ideal turnover? Is there such thing as an ideal turnover for every retailer? And that's totally not the case. No one idea that fits every retailer. Okay, an ideal turnover can vary depending on the product type, depending on the departments, even within the same like a store, or depending on the stores, like store to store, even for the same retail company, between different stores, there can be different idea turnover. Okay, for different vendors again, because the vendors provide different kinds of products, right? So a lot of times when we try to kind of gauge what would be an ideal turnover, we look at our past history and and kind of the memory of what happened. If it went fine with that much high of turnover, or did we feel like our merchandise was not moving through really quickly enough, then we will have to increase our turnover based as compared to what happened in last year. Or if we feel like merchandise was moving through too fast, then we frequently had a situation where we didn't have enough merchandise in our stores, then that probably means that the turnover we achieved last year was too high, so we will have to reduce it in this year. Right? So you kind of have to take a look at your own history, but also you can compare your turnover to the industry average. Okay, what's the average turnover in the industry? Right? And kind of see where your company or store is at as compared to the industry average. Um, the Census Bureau provides the kind of industry average turnover figures, and sometimes some trade publications may provide that information. You want to always keep track of the statistics, your industry statistics, to be able to understand what the industry average is. Like for example, the annual turnover for children's wear may be like around 4. So like almost every quarter, you will have the entire stock kind of sold and replaced. Okay. But average turnover for shoes department is actually lower. Okay, for shoes, a lot of shoes, the same shoes can be actually sold throughout the year, right? Across the seasons. So some of the merchandise may be actually sitting in the store a little bit longer than maybe apparel stores may experience. So the annual turnover for shoe store for industry average is actually around 2. So it can all vary by product types and the industry you are working in. So there's no one ideal turnover, but you always have to look at your own history as well as the industry average and try to find an ideal turnover for your own situation and aim at it. Okay, this concludes module number 15, and in this module we took a look at one type of stock efficiency measures, which is turnover. In next module we are going to take a look at another type of stock efficiency measure. Okay, thank you for listening, and don't forget to work on module problem assignment number 15.